Ever wondered how some people seem to effortlessly grow their wealth through investing? Today, we're diving into the art of mastering the 20 rules for successful investing. If you're ready to unlock the secrets that can transform your financial future, stick around. And hey, if you're new here, don't forget to subscribe and hit that notification bell so you never miss out on our insights. Imagine someone who started with very little, just like many of us. They took small steps, learning the ropes of investing one decision at a time. Along the way, they faced challenges, moments of doubt when markets shook and others panicked. But this person persisted, applying principles that became their guiding light. They understood the importance of not just chasing returns, but protecting their capital, always looking for opportunities that offered a margin of safety. One day, they stumbled upon a timeless concept: investing in quality companies at a discount. It wasn't about timing the market, it was about patience and conviction. Through the ups and downs, this approach paid off as they watched their investments grow steadily over the years. They learned from their mistakes, staying rational amidst market euphoria and fear. And as they continued on this journey, they realized that knowledge truly is power, constantly learning, evolving, and staying humble despite their successes. This story isn't about luck or genius. It's about mastering the principles that underpin successful investing. Today, we're diving into those very principles, exploring how you can apply them to your own financial journey. Let's get started. Let's talk about the number one rule in investing: don't lose money. It's not just about making gains, it's also about protecting what you already have. Imagine your investment portfolio as a garden. You wouldn't want pests or bad weather to destroy your plants, right? Similarly, in investing, we aim to minimize risks that could wipe out our hard-earned money. One way to do this is through diversification. Instead of putting all your eggs in one basket, spread your investments across different types of assets. That way, if one investment doesn't perform well, others might offset the losses. It's like having a backup plan for your financial future. Another strategy is to steer clear of high-risk investments that promise quick riches but could also lead to big losses. Think of it as avoiding roller coasters in favor of a steady ride. By focusing on stable investments with proven track records, you can protect your portfolio from unnecessary ups and downs. Remember, the key to long-term success in investing is not just making gains, but also safeguarding what you've already achieved. So, think smart. Diversify wisely, and watch your investments grow steadily over time. Now let's talk about keeping track of your investments. Performance is crucial for success in the market. It's like tending to a garden. You need to check on it regularly, prune where necessary, and nurture growth. Conducting periodic reviews of your portfolio allows you to see how each investment is performing. This helps in identifying which ones are thriving and which might need adjustments. Rebalancing your portfolio is another important practice. Over time, some investments may grow faster than others, throwing off your desired asset allocation. By rebalancing, selling some of the overperforming assets and buying more of the underperforming ones, you can bring your portfolio back in line with your financial goals. Staying informed about market changes is key. Markets are dynamic, and economic conditions can shift quickly. Being aware of these changes helps you make informed decisions about your investments. For example, during times of economic uncertainty, adjusting your portfolio to include more defensive stocks or reallocating to safer assets can help protect your investments. Active portfolio management isn't just about checking numbers, it's about adapting to the ever-changing landscape of the market. By regularly reviewing and adjusting your portfolio, you increase your chances of achieving long-term financial success. Remember, a well-maintained portfolio is like a well-tuned engine. It runs smoother and delivers better results over time. Let's talk about something crucial: having a safety net when you invest. Imagine you're buying a car. You wouldn't pay top dollar if you knew it was worth less, right? The same goes for stocks. The margin of safety concept means buying stocks when their price is lower than what they're really worth. It's like getting a discount on something valuable. To figure this out, you look at things like how much money the company makes compared to its stock price. That's the price-to-earnings ratio. You also check how much debt they have versus how much money they have. The debt to equity ratio. These numbers tell you if the stock is priced right or if it's overpriced. Warren Buffett, one of the best investors ever, used this strategy when he bought shares in companies like Coca-Cola. He waited until the stock price was lower than what he thought the company was truly worth. And when the market realized Coke's real value, his investment paid off big time. By the way, if you're enjoying the video so far and want more topics like this, comment the word investing so I know. Now let's talk about how to spot a strong investment beyond just looking at its stock price. It's not just about what the stock is worth right now. It's about what the company is really like under the hood. You want to dig into its financial health, things like how much debt they have compared to how much money they're making. This helps you see if they're managing their finances well and can weather tough times. For example, imagine you're looking at two companies in the same industry. One might have a low stock price that seems like a steal, but it's struggling with a mountain of debt. The other might have a higher stock price, but it's consistently turning a profit and has manageable debt. In the long run, the company with solid financials is likely to be the smarter bet, even if it costs a bit more upfront. Understanding these financial metrics, like profit-to-earnings ratios and how much cash they have on hand, gives you a clearer picture of a company's stability and potential for growth. It's like checking under the hood before buying a car. You want to know it's in good shape to go the distance. All right, let's talk about why patience pays off big time in investing. When you invest for the long haul, you're not looking for quick wins. Instead, you're planting seeds that can grow into mighty oaks over time. Think of it like tending a garden. You plant the seeds, water them regularly, and patiently watch them grow into beautiful plants. The magic happens with something called compounding. It's like a snowball effect where your money earns returns, and those returns then earn returns of their own. Over years and decades, this compounding can turn even modest investments into substantial wealth. Just look at investors who stuck with companies like Amazon or Apple for years. They saw their initial investments multiply many times over. So mastering these rules for successful investing isn't just about picking the right stocks, it's about having the patience to let them flourish. Remember, Rome wasn't built in a day, and neither is a well-rounded investment portfolio. Stay focused on the long term and you'll reap the rewards. Let's talk about keeping your money safe. It's not just about growing it, it's also about protecting what you already have. One big rule here is to avoid taking unnecessary risks. What does that mean? Well, it's about being smart with where you put your money. Imagine you have a basket of apples. You wouldn't want to put all your apples in one basket, right? That's diversification, spreading out your investments, so if one doesn't do well, the others can pick up the slack. Another thing is to watch out for investments that promise big returns fast. Sure, those can be tempting, but they often come with a lot of risk. It's like jumping into a deep pool without knowing how to swim. You might make a big splash, but you could also sink. Looking back at history, we've seen times when people lost a lot because they took too many chances. By being cautious, like checking how stable a company is before investing, or sticking with investments you understand, you're protecting yourself from unnecessary losses. It's like wearing a seatbelt in a car. It might seem like a small thing, but it can make a big difference when things get bumpy. So remember, keeping your money safe is just as important as making more of it. Now, let's talk about a savvy strategy in investing, finding great companies when they're on sale. Imagine walking into your favorite store and finding your most wanted item at a fraction of its usual price. That's similar to what we aim for in investing. When we look for undervalued opportunities, we're hunting for those hidden gems in the stock market. These are companies whose true worth isn't fully recognized by other investors yet. How do we spot them? Well, it involves digging deeper than just looking at the stock price. We analyze things like the company's potential for growth, its financial health, and how it compares to others in its industry. A good example is when famous investors like Warren Buffett bought into companies like Coca-Cola or Apple when their stock prices were lower than what the companies were actually worth. By doing this, they were able to grab these stocks at a discount before their values soared. It's like buying a valuable collectible before it becomes famous and expensive. It's all about seeing the potential before everyone else catches on. Let's talk about understanding the businesses you invest in. Here's the deal. The less you know about a company, the riskier it is to invest in it. Imagine you're looking at two businesses, one in technology and another in retail. If tech jargon confuses you, but you've worked in retail all your life, then investing in retail might be safer for you. Why? Because you understand how retail works, from customer behavior to seasonal sales trends. Now, here's the trick. When you're investing, stick to what you understand. If you're tempted by a new industry or a complex business model you don't get, your margin of safety should be larger. That means you should demand a bigger discount or more convincing proof of success before investing. It's like buying a used car. You'd ask more questions and do more checks if you're not familiar with the model. Investing in what you know reduces the chances of making costly mistakes. So take the time to learn about the businesses you're interested in. Read their financial reports, understand their products or services, and follow industry news. This way, you'll make smarter investment decisions and grow your wealth with more confidence. Now let's talk about a fascinating strategy in investing called contrarian thinking. Imagine this: when everyone around you is super excited and jumping into the latest hot stock or trend, that might actually be a signal to step back and think twice. Why? Because when everyone is greedy and prices are soaring, it often means things are overvalued and a correction could be around the corner. On the flip side, when fear grips the market and everyone is selling in panic, that's when opportunities can arise. Think about it like shopping during a big sale. You're getting quality items at a discount. Similarly, in investing, when others are fearful and prices are low, it might be a great time to consider buying stocks or assets that have strong fundamentals but are temporarily undervalued. Legendary investor Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." This mindset isn't about following the crowd, it's about being smart and strategic. By going against the herd mentality and making decisions based on solid analysis and research, you can position yourself for potential long-term gains. It's all about finding those hidden gems when others are looking the other way. When it comes to investing, quality often trumps quantity. Imagine you have a choice. You can either invest in a handful of outstanding companies or spread your money across numerous average ones. The key here is to focus on those few gems, companies with solid financial health, strong market positions, and potential for long-term growth. These are the investments that can truly make a difference in your portfolio. Let's break it down. Investing in quality means seeking out companies that not only show promise now, but have the potential to thrive in the future. It's like building a collection of rare coins instead of hoarding loose change. Each high-quality investment you make has the potential to deliver substantial returns over time, outperforming a larger basket of mediocre investments. By concentrating your resources on these winners, you're not only reducing risk, but also maximizing your chances of success. Remember, mastering these rules for successful investing isn't just about playing the numbers game. It's about making strategic choices that align with your financial goals and principles. So next time you think about expanding your portfolio, ask yourself, am I chasing quantity or am I investing in quality? Remembering to focus on quality over quantity is a cornerstone of mastering these rules for successful investing. When it comes to investing, sticking to what you know can be your secret weapon. Imagine you're a car enthusiast who knows everything about engines and performance. You wouldn't invest in a technology company just because it's popular, right? Your circle of competence is like your comfort zone in investing. It's where you have the most knowledge and understanding. Let me tell you about Chris Gardner, whose story inspired the movie The Pursuit of Happiness. Chris started with very little but understood the stock market because of his job as a medical equipment salesman. He focused on healthcare companies and medical technology, areas he knew inside out. His deep understanding helped him make smart investment decisions, eventually turning his life around from homelessness to becoming a successful investor and entrepreneur. So, whether it's fashion, technology, or real estate, invest in what you truly understand. It's not about following trends, it's about leveraging your expertise to make informed choices that can lead to long-term financial success. Let's talk about a common trap many investors fall into: trying to time the market. It's like trying to predict the weather. Sometimes you get it right, but often you don't. Market timing means jumping in and out of investments based on short-term market movements or predictions. Here's the deal. Research shows that trying to time the market is risky. Even seasoned investors find it hard to consistently predict when to buy low and sell high. Instead, a more reliable approach is to stay consistent with your investments over the long haul. Imagine this: you have a favorite fruit tree. You don't check it every day expecting fruit. You water it regularly, nurture it, and patiently wait for it to bear fruit in due time. Similarly, consistent, long-term investments allow your money to grow steadily over years, benefiting from the market's natural ups and downs without trying to outguess them. History backs this up. Investors who stick to a long-term strategy tend to see better returns compared to those who constantly react to market noise. So rather than timing the market, focus on time in the market, letting your investments grow steadily over time. It's a proven way to build wealth without the stress of trying to beat the market's twists and turns. Now, let's talk about why following the crowd might not always be the best move when it comes to investing. Imagine a crowded street market where everyone rushes to buy the latest trend in gadgets. Just because everyone else is buying doesn't mean it's the right choice for you. In investing, this herd mentality can lead to decisions based on hype rather than careful analysis. Independent thinking in investing means taking the time to research and understand why you're making a particular investment. It's about trusting your own judgment rather than following what everyone else is doing. For instance, when the stock market is booming and everyone seems overly optimistic, it might be a signal to be cautious. Conversely, during downturns when fear dominates and stocks are undervalued, it could be a buying opportunity. Successful investors often go against the grain, making decisions that are grounded in their own research and analysis. This approach requires confidence in your own ability to assess risks and opportunities. By staying independent-minded, you can make more informed and potentially more profitable investment choices over the long term. Let's talk about patience. Investing requires patience. Like tending a garden, you plant seeds, water them, and wait for them to bloom. Similarly, your investments need time to grow and flourish. Instead of rushing to harvest at the first sign of growth, allow your investments to compound over the years. Consider this: many successful investors didn't see substantial returns overnight. They patiently held onto their investments, allowing them to appreciate in value gradually. This approach not only reduces the stress of constantly monitoring market fluctuations, but also maximizes your potential gains. Patience also means resisting the urge to react impulsively to short-term market movements. Just like a roller coaster, markets can have ups and downs. By staying patient during downturns, you give your investments the opportunity to recover and thrive when conditions improve. Remember, the most successful investors often attribute their wealth to staying committed to their investments through thick and thin. Patience isn't just a virtue, it's a strategy that can pay off handsomely in the long run. So sit back, relax, and watch your investments grow over time. Now, let's talk about another crucial aspect of successful investing: minimizing fees to maximize your returns. When you invest, fees can quietly eat away at your profits over time. It's like paying small tolls along your investment journey. Even seemingly small percentages in fees can add up significantly over the years, reducing the overall growth of your portfolio. To keep more of your hard-earned money working for you, consider low-cost investment options like index funds or exchange-traded funds, ETFs. These funds often have lower management fees compared to actively managed funds. Additionally, look for brokerage platforms that offer competitive fee structures and no-load mutual funds. By being mindful of fees, you're not only saving money but also giving your investments more room to grow. Remember, mastering these rules for successful investing isn't just about what you earn. It's also about what you keep. Taking small steps to minimize costs today can lead to larger gains down the road, helping you achieve your financial goals faster. So whether you're just starting out or refining your investment strategy, Always keep in mind the importance of minimizing fees to maximize returns. Let's talk about something every investor faces: mistakes. We all make them. It's part of the journey. The trick isn't avoiding mistakes altogether. That's nearly impossible. But rather, learning from them and growing smarter with each experience. When you make a mistake in investing, whether it's buying a stock that didn't perform as expected or selling too early, take the time to reflect. Ask yourself, what went wrong? Was there something I missed in my research? Did emotions cloud my judgment? By analyzing your decisions honestly, you gain insights that can prevent similar missteps in the future. Document your mistakes and the lessons learned. This isn't just about writing down numbers. It's about understanding your thought process at the time and how it influenced your actions. Maybe you underestimated market trends or overestimated a company's potential. Whatever it is, this documentation helps you spot patterns and refine your strategy over time. Successful investors aren't immune to mistakes. They're just diligent about turning them into opportunities for growth. Let's talk about why staying cool-headed is crucial when you're investing. See, emotions can really mess with your decisions. When you let fear or greed take over, you might end up making choices that aren't so smart for your money. Imagine this: the stock market starts to drop, and everyone around you is panicking, selling off their investments in a frenzy. It's tempting to follow the crowd, right? But here's the thing: sometimes that panic is just temporary. Markets go up and down all the time, and if you react emotionally, you might end up selling low and missing out on potential gains when things stabilize. On the flip side, when everyone's riding high on a market boom, it's easy to get caught up in the excitement and start buying like crazy. But buying at inflated prices can be risky. That's where rational thinking comes in. It's about stepping back, looking at the facts, and making decisions based on solid research and your long-term goals. So, whether it's fear or euphoria, keeping a clear head and sticking to your investment plan can help you make smarter choices. Remember, investing is a marathon, not a sprint. Let's talk about why constantly learning is super important when it comes to investing. Think of knowledge like a superpower in the world of finance. It's your best tool for making smart decisions. Here's why. Staying updated on what's happening in the market, understanding new trends, and knowing different investment strategies can really give you an edge. Imagine this: you're driving a car, and you know the road ahead has twists and turns. Would you rather have a map showing you where to go, or just guess your way through? That's what knowledge does for your investments. It acts like your roadmap, guiding you through the ups and downs of the market. But it's not just about reading books or watching videos, although those help. It's also about staying curious and asking questions. Maybe you're wondering about a new technology or a company's latest product. You dive in, learn about it, and see if it fits into your investment plan. The best investors are always learning, adapting, and growing. It's not just about knowing what's happening now, but also preparing for what could happen next. So keep that curiosity alive, keep learning, and watch how it transforms your investing game. Knowledge truly is your best asset on this exciting journey. Let's talk about why staying positive about the future can be a game changer in investing. Being optimistic isn't just about feeling good, it's about spotting opportunities that could lead to big returns down the road. Imagine this. Think of investing in things that are shaping the future, like new technologies or advancements in healthcare. These are areas where exciting developments are happening, and they could potentially bring substantial growth to your investments. For instance, consider renewable energy. As we move towards cleaner sources of power, companies in solar or wind energy might see significant growth. Investing in these sectors now, when they're on the rise, could pay off handsomely in the future. Another example is tech innovations. Think about how smartphones and the internet have changed our lives. Investing in breakthrough technologies that could be the next big thing, like artificial intelligence or biotech, could position you for impressive returns as these industries evolve. So being optimistic isn't just wishful thinking, it's about spotting trends and investing in progress. By staying upbeat and looking ahead, you're not only investing in companies, but also in the future possibilities they represent. It's about seeing potential where others might not, and that's the key to successful investing. Now let's talk about staying humble in the world of investing. You see, no matter how skilled or experienced you are, mistakes happen. Even the most successful investors have their moments. It's not about avoiding mistakes altogether, but learning from them. Being humble means acknowledging that you don't have all the answers and that the market can surprise even the brightest minds. It's about staying open to learning from every investment, whether it turns out to be a home run or a lesson in resilience. Embracing humility keeps you grounded, helping you bounce back stronger from setbacks and make better decisions in the future. Remember, investing is a journey of continuous improvement. By staying humble, you remain receptive to new ideas, strategies, and opportunities. It's not just about being right all the time. It's about growing wiser with every experience. Thanks for watching our video on mastering the 20 rules for successful investing. I hope these tips help you on your investing journey. Remember, successful investing takes time, patience, and continuous learning. Keep these rules in mind, and you'll be better prepared to make smart investment decisions. Remember, the purpose of this video is to broaden your horizons in the realm of investing. It's not about handing you a ready-to-eat financial meal, but about teaching you how to cook one yourself. Investing comes with its share of risks and uncertainties, so it's crucial to wear your research hat and consult with qualified professionals before making any financial decisions. Keep in mind, past performance in investments is like last year's weather forecast. It doesn't necessarily predict what's going to happen tomorrow. Always weigh the risks and tread carefully when putting your hard-earned money at stake. Now, if you found this video helpful, I highly recommend watching my next video, which is the perfect complement to this one. Thank you for joining us today, and don't forget share and subscribe to our channel. Your engagement is like applause for our efforts, and it motivates us to bring even more valuable content your way. So feel free to drop a comment below. I appreciate your support, and I'll see you in my next video.